Hey traders, you are welcome back to the Forex Geek channel. In this video, I'm breaking down one of the most effective trading strategies, which is the EMA and Stochastic Strategy. So if you are struggling to time your entries and exits, this setup will help you identify trends, avoid false signals, and catch high probability trades. Stick around till the end because I'll be showing you a step-by-step guide on how to use this strategy in live market conditions. Now, let's just quickly start with the basics, okay? The exponential moving average is a trend following indicator. The trend following indicator that smooths out price action and helps us determine whether the market is trending up or down. On the other hand, the stochastic oscillator, is a momentum indicator that shows when a currency pair is overbought or oversold. So by combining these two, we can filter out bad trades and increase our chances of catching strong moves in the market. Now, let us break it down into simple steps that you can start using today. All right. I'm just going to set this EMA to 50 period. I'm going to use the 50 period EMA. All right. Okay. So now the 50 EMA is used to define the market direction. If the price is above the 50 EMA, we are looking for buy setups. If the price is below the 50 EMA, we are looking for sell setups. So this ensures that we only trade in the direction of the trend and avoid unnecessary losses. The second step is to confirm the entries with the stochastic. All right. Now let's go to the settings. We're going to be using the percentage K length to be 14, the percentage K smoothing to be 3, and the percentage D smoothing to be 3. All right. Okay. So the stochastic oscillator helps us find overbought and oversold conditions. If the stochastic is below 20, the market is oversold and we look for buy opportunities. If the stochastic is above 80, the market is overbought and we look for sell opportunities. However, we don't enter a trade just because the stochastic is in these zones. We need extra confirmation. Now, the third step is to wait for a pullback to the EMA. Let's go to an uptrend, okay? Let's go to an uptrend. Now, in an uptrend, we wait for the price to retrace to the EMA. Now, we can see that there was a change in trend around here, right? This was a sell trend, and then we had a breakout from this bearish trend line, and then, of course, you can see that the price started moving above the EMA. So, after the price has crossed above the EMA, we wait for a pullback to the EMA, like what happened here. All right? Wait for the price to retrace to the 50 EMA. If the stochastic is oversold, and the price touches the EMA, it's a strong buy signal. So you can see the stochastic entered oversold around here. Price touched the EMA. So this was a good time to enter a buy. Stop loss below previous swing low. Take profit around key resistance zones. All right? Around key resistance zones. On the other hand, let's go to a downtrend. In a downtrend, we wait for the price to pull back to the 50 EMA as well. You can see something around here. After this happened, you can see how the price pulled back. This was a good selling opportunity. Enter a sell after you confirm your opportunity. Set your stop loss above the previous swing high. Take profit can be around key support zones. Okay. If the stochastic is above the overbought region, or rather in the overbought region at the same time, is a strong sell signal. So you can see that around this time when the price dropped below the moving average, the stochastic was already above the overbought territory, or rather within the overbought territory, and it came down, and that was before this retest happened. So this was a good selling opportunity. But make sure you always get candlestick confirmations. It's important. Before entering a trade, we need to see price action confirmation. The best signals come from patterns like bullish engulfing, that's for a buy trade, or maybe bearish engulfing for a sell trade, or pin bars, rejection wicks, showing market rejection at the EMA. For example, here, you can see we had a bullish engulfing. Right? Now, here, you can see that we had a bearish engulfing. Look at, you can see that we had a bearish engulfing around here. So make sure you get confirmation candlestick patterns. It's important. Then for your stop loss and take profits, do not neglect them. Do not neglect them, because risk management is key to long-term success. You have to place your stop loss below the recent swing low for a buy trade. If you're entering a buy trade, the stop loss should be below the recent swing low. If you're entering a sell trade, the stop loss should be above the recent swing high. All right, it's important. Then for your take profit, for a buy trade, you can use previous highs or resistance levels, right? For a sell, you can also use previous lows or support levels. So to improve your accuracy with this strategy, here are a few extra tips. Avoid trading in choppy markets. This strategy works best in trending conditions, all right? And then use the higher time frames for confirmation. The 1 hour and the 4 hour charts provide better signals than lower time frames. And also combine with other confluences. If price is at a strong support, for example, if price is at a strong support or resistance level, while aligning with the EMA and stochastic, the setup is even stronger. And that is how you trade with the EMA and stochastic strategy. This method is simple, yet powerful when used correctly. If you found this video helpful, make sure to like and subscribe for more in-depth trading strategies. Also, drop a comment below if you have any questions or if you want me to cover another strategy next time. Thank you for watching, and I look forward to seeing you in the next video. Happy trading.